Welcome back. Today we're going to part 2 of prepaids and accruals. Last time we looked at prepaid revenue. Now we'll look at its counterpart, accrued revenue. Much like companies can receive payment before services are performed, companies can also perform services before payment is received. This is called an accrued revenue. Accrued revenue results in a debit to accounts receivable, an asset, and a credit to revenue. Accounts receivable is a current asset that refers to the amount owed by customers to the business. The business can collect payment from customers on accounts receivable at a later date. Let's look at an example. Burnwood Holdings performs $3,000 of services, however, the customer will pay the bill next month. This results in a debit to accounts receivable as payment is to be received, and a credit to service revenue as services have just been performed and earned. The journal entry would look like this. There is a debit to accounts receivable and a credit to service revenue. To collect on accounts receivable, it is simply a credit to accounts receivable and a debit to the appropriate asset, which is usually cash. Let's say a business collects a portion of payment from the previous transaction in cash. There is now a debit to cash and credit to accounts receivable. The business collected cash from the customer and no longer has a customer owing $3,000. The journal entry to collect looks like this. Cash is debited for $3,000 and accounts receivable is credited for $3,000. That's it for part 2. We'll finish off this topic in part 3.